Hi, welcome to Risk Awareness Week. My name is John Hollmann, and I'm going to be presenting on the topic of project risk quantification. The subtitle is Methods That Work, and we're going to talk about what I mean by that. But I hope you enjoy this. If you have any questions, please post them in the comments or whatever, and hopefully they'll get answered promptly. Appreciate your being here. Let's start off with a little introduction to myself. For those of you who aren't familiar with me, I own my own small firm, Validation Estimating, since 2005. I work in the process industries mainly, and I've worked in owner, engineering, research, and other organizations. But I've also covered industries such as power, mining, infrastructure, and so forth. I am originally a cost estimator and project controls person, but over the last decade or 15, 20 years, I've shifted more and more to risk, which I feel is probably the biggest area of improvement in investment decision making. So this topic, this discussion today will be mostly about major projects in engineering and construction. If you're in another industry, I think the principles will apply. But the specific models I'm going to be sharing are for those types of investment projects. My background, I've been very active in an organization called AACE International, which I feel is kind of the world's foremost organization for quantification of cost and schedule and use in project controls and investment decision. So if you're not familiar with that, I'd appreciate maybe you checking that out. I've written several books. One, I was the lead author of the AACE Total Cost Management Framework, which is the process that underlies cost engineering. And most recently published the book Project Risk Quantification. And for those of you in the seminar, you can acquire that book through Kindle or in a hard copy version at a discounted price with a link that should be available to you. I am a mining engineer, and I also have an MBA from Indiana University of Pennsylvania. So the presentation you're about to see is based upon the book from 2016. So many of the slides are taken directly from the book, and I feel it covers the methodologies that I propose pretty fully. So if you really want to get an understanding of this, I would suggest you read the book. I do want to point out that risk quantification, which is the subject of this presentation, is just one step in the overall risk management. I think it's the orphan step, meaning that people don't do the quantification very well. So I feel it's a big gap that needs to be filled. Risk quantification really comes to play at the point of decision making. So in some respects, this presentation is really about the basis of investment decisions and quantifying the risks that have to be considered in that decision. People ask me about the book and why there's an image of the god Janus there. I think it represents the theme of the book pretty well. The god Janus had one phase looking in the past, which was pessimistic. Another one looking in the future, which tended to be optimistic. What we have to do in risk quantification is have both views. We have to use the past to learn from and to keep ourselves honest, but we can't use that pessimistic view as a basis for the future. We need to improve. We need to be realistic, but we also need to strive to improve our performance. So we need both phases. Project risk quantification, which I use the acronym PRQ, I apologize for the acronym, is essentially just probabilistic modeling of the impact of all identified risks in a project or associated with the project. And in order to be an effective method, there are a number of principles that need to be followed. First, the quantification needs to integrate cost and schedule. You cannot look at each of them in themselves. You can't have the cost evaluation one day and the schedule the next, because they are really different permutations of the same thing. There is also something we call cost schedule trading going on, that every time you make a decision, you are trading cost for schedule or vice versa, and we can't talk about one without talking about the other. The second principle is that the methodology needs to align with project controls, because in the end of the day, we do need to incorporate the risk and the actions associated with them in our plans. So you can't have a method that doesn't support that. Third, we need to integrate with the business need, which is primarily the investment decision. There are people in the business that are going to be doing net present value and other type analysis of the investment. We have to work with those folks, we have to communicate with them, and we have to provide the inputs that they need. And then the last bullet is to integrate with commercial aspects. If you're a contractor, you can apply these methods, somewhat different approach to support your bid pricing strategy, but also your decision to bid at all. We have to make different types of decisions. So the methodology needs to be able to address these various ideas. And if anybody, again, has any questions about this, please post the comments. I mentioned at the start that I'm going to explain what I mean by methods that work. Well, first of all, the method needs to be realistic. What's the point of doing quantification if the outcome of our analysis does not match reality? Unfortunately, we're going to talk in a bit about the fact that our methods to date, the traditional methods that have been used, do not match reality, and how we need to fill that gap. Second, it needs to be practical. So in my practice in estimating and project controls and so forth, what I find so often is that people are espousing methods that are simply not practical to apply on the day-to-day projects that companies have to deal with. They're often the domain of experts and consultants that are very deep into the statistics and the modeling, which is fine for a strategic project, but it's not something that we want to espouse for a company as its base method if they can't use it for the small stuff or the average stuff. We also need to be cognizant that companies need to rely on their internal resources. So we have to have a method that in-house engineers, estimators, project specialists, and so forth are able to apply with some reasonable expectation of quality. And then third, for a method to work, it needs to be integrated. And we just talked about that integration aspect, and be able to apply it as part of a project management process, such as a phase gate process, which the methods I'm going to show you are intimately linked to phase gate type process systems. So the first question then about methods that work is, how realistic are they? Well, I was involved in a study about 15 years ago when I worked at a company called IPA, which does benchmarking of capital projects. And the finding of that study was, as you can read on the screen, that contingency estimates on average appeared to be getting further away from the actual contingency that was required on projects. And at the time, that was surprising because of the use of different tools using Monte-Carlo and so forth had become fairly prevalent, but it wasn't working. And actually, we found that the contingencies in the past, the distant past, were probably a little more realistic than the ones coming out of our method. So that showed there was a big gap that needed to be filled, and that kind of led me down to the path of what you're hearing today. This slide in front of you shows the gap that we just talked about between reality and what we've been estimating. On the chart, you can see the cost accuracy range, and the white bar is the range that we are estimating or quantifying and reporting to our decision makers. So when they get a capital project, we're often telling them that the range, and if you're a statistician, you know, something like a P10 to P90, is maybe plus 30 minus 10%. So the business person is going to put that plus 30 into their net present value sensitivity analysis. And really what it happens is that CapEx tends to be irrelevant to them, because a 30% CapEx overrun is probably not going to kill the economics of a project. Now the gray bar shows you what the research shows the actual range of major capital project cost outcomes is. And you can see it's on the high end over 70 or 80% overrun at a P90. On the low end, it is pretty close to the -5, -10%. We don't underrun very much, but we overrun drastically. And the rule of thumb, although I'm not going to suggest using this rule of thumb is in your decision, is that the high end of reality is about 2 to 3 times what we typically have been reporting to management as the high end. And I'm going to show you some more examples of that. If you have any questions about the details of this statistics and numbers and so forth, again, you can post some comments and we can fill you in. So as an example, it's a little bit busy graph here, but this was a study that I supported in 2014, I believe. This was a consortia of hydropower companies, Canadian provincial authorities. We collected all of the projects they had done in the recent past, major projects, and looked at the accuracy of their estimate. And interestingly, this is not done very often in most studies, is we looked at the accuracy at each phase of the phase gate system. So we looked at the very early strategic estimates, and we also looked at the sanction estimate. Now, what you'll see on the slide, and hopefully you can see at the top, is that the class 5, or the very first estimate, the range was +300 to +15. In fact, we very rarely, if ever, underrun our original class 5 estimate. And then as we develop the scope a little more, we get estimates of +100, -0. Finally, when we get the sanction, the range was +50, -10, which is that box on the center of that diagram. But again, the takeaway is that that high end of that box is about 2 to 3 times what people are expecting and what our traditional methods have done. I'm also kind of a student of this research on accuracy, and I can tell you that the contingency in P90 underestimation is seen in every study I've ever seen. We have a true problem in industry, and we need to change our standards, but we also need to look at our methodology, because these ranges are simply 2 to 3 times the span or width of what we're telling people. Now, there's a second problem with the reality question, is that we're failing in our methods to recognize bias. Bias in the base estimate, bias in our schedule durations, and so forth. So there's not just uncertainty and risk and events and things that happen to you, but there is also the uncertainty of the estimators having bias, the project managers having biases, the decision makers all having biases. So as an example of that, I have a diagram. This is an actual distribution of the accuracy range on a small project system. This was a particular refinery in the US, and this was a 1-year portfolio of about 300 of their projects that are done in 1 year. And what you can see is that they very rarely overrun. The mode of this distribution is about 1, which means they're on budget, but projects tended to underrun, meaning that the estimate was overestimated. And that was actually their means of project control, was that you overestimate the project by about 20%, and then hope you give the money back at the end of the day. And at the end, that costs you some interest, but actually it's a way to get things done quickly with minimum fuss. But that's a bias built into the system, and we have to accommodate that. Whether the bias is good or bad is another question. But our methods have to address the fact that we may be working in a particular culture that has that bias, and we have to quantify that, consider that. There are other biases that we could talk about, but I'm using this one as an example because it's fairly pronounced, and this small project syndrome or dichotomy is almost universal. Another failing we have on this next slide, and I hope you're keeping up. I'm rattling through these pretty quick, but again, please ask questions as we go along. But we failed to quantify escalation risk. There is a lot of confusion in decision makers and in the finance world about what escalation is. The prevalent confusion is that it's confused with inflation. Inflation is part of escalation, but often in a volatile time, a very small part. But unfortunately, finance views cost trends as being inflation. The slide you see in front of you is actually a study of showing escalation versus inflation. The bottom line is the Consumer Price Index from the US Bureau of Labor Statistics. And you can see from a volatile time from 2004 through 2010, which is a very, we call it the super cycle in the project world because costs increased so much. You can see inflation was actually fairly nominal, only increased by 3 or 4% a year. The very top line is the sell price, or the actual price owners had to pay to get a process plant project built. And you can see that, and that came from IHS Marquette is the new name of the company. That's called their downstream capital cost index. But you can see the escalation. What you had to pay to get something built was 2 to 3 times the inflation. During that super cycle, the bid prices for engineering construction just went through the roof, along with the prices of commodities like steel and copper. And I think many of you that lived through that are quite familiar with what I'm talking about. But unfortunately, most of the project estimates included only that nominal inflation in their estimates, and those projects got burned badly. We simply weren't quantifying the right risk, and we didn't have the methods to do so. As if we don't have enough problems, there's another and an increasingly growing concern with the impact of complexity. There's been 20, 30 years of research on complexity. Academic world loves to talk about it, and there's all kinds of academic treatments of it. But unfortunately, that hasn't been brought to the table as a practical method of quantification. So in the book, I have some hypotheses about the nature of complexity and the impact on project costs. It's based on my own experience from working with a benchmarking firm and my own experience with major projects as a consultant. But my own hypothesis, which is illustrated on this graph, is that complex projects don't fail the same way merely large projects fail. Large projects have a lot of uncertainty with the plus 50, minus 10 type of thing. But what happens in a complex project? You have a nasty combination of a weak system, the complexity itself, plus you have stressors or external risks impacting the project. And if you combine those together, basically you end up with a blowout. A blowout tends to be typically a doubling or tripling of the labor-related costs. We see it again and again. But when you have a blowout, you get kind of a bimodal distribution. So you either have just a merely lousy project, or you have a blowout, which can destroy the economics of your capital program. And there are small to moderate companies that have attempted mega projects and have destroyed their financial strength and driven themselves into drunk bonds by attempting these mega projects without having the financial wherewithal. So we need to be able to warn management that their systems and the complexity and the potential risk events combined could be pushing them over this tipping point into a blowout scenario, which they really want to avoid. This is not a project they probably want to take on unless they change the scope or execution strategy significantly. There are some that think this outcome, and particularly in the academic world, is the result of bias or lying. I am very much, I see no evidence of that in the research. This is all explainable by first principles of project behavior. We don't need to talk about lying and strategic misrepresentation to explain that. Another challenge in the risk methods is that we don't consider risk responses. Now, there's a lot of terminology in the risk world. A lot of that terminology is confusing. When I talk about risk response, I'm not talking about risk treatment. Many of you are familiar with these terms, but risk treatment is an action you take to mitigate, transfer, or otherwise manage the risk ahead of time. A risk response then is once we accept the risk or once we have residual risk, what are we going to do if that risk happens? a way to look at a risk response is that response is the scope of the estimate of the risk impact. And what I find in risk quantification so often is people are estimating impacts without actually talking about impact for what. And if you're an estimator, you know you have to have a scope before you can do an estimate. Well, the scope is the answer of the question. If this risk happens, what will you do? Well, there's many things you could do if the risk happens. If you have a landslide, let's say, well, we could build a new road to avoid the landslide area. Or we could bring in a lot of big dozers and clean up the landslide. Or we could drive right over the landslide of the new road. But we have to answer that question of what would we do, and then we can develop a range cost impact estimate from that. And the answer of the risk response then is one about trading. If management is focused on completing the project on time, you're going to have a maybe fast response, but it's going to be very expensive. If management's focused on cost, you may come up with a slower response, but a little more, less costly than the first one. We have to consider that cost schedule trading question. So anyway, it's a different approach to risk quantification workshops. The workshop is focused on discussing these contingency plans or risk responses going forward. And if you don't have that discussion, you're quantifying things simply from midair, just guesswork, and we don't want to use guesswork in this method. So those are a lot of negatives about why what we've been doing is not working, why the actual range is 2 to 3 times the span of the estimated range. So let's talk a little bit about what does work. Well, first we have to have a process. Oh, by the way, again, all these diagrams are from my book. If you have any questions about any of the research questions that we just went through, I can please post them. I can give you the reference source, the studies, the papers, the books that this information comes from. But anyway, going forward, let's go back to how do we do risk quantification. First of all, we need a process. That process has to have methodologies that maps the types of risks that we're facing and the planning needs. So not only does it have to consider what risks we have, but the outcome of the quantification has to support budgeting. It has to support decision making. It has to cover all the risks step by step and then accumulate the findings until you have one big picture to give to the business people to support their decision. We can't go in with 5 different numbers and totally confuse them, and the statistics and so forth can be very confusing to decision makers. We need to simplify that, be clear, but also comprehensive. So each step in this diagram supports the next one. And it looks pretty busy, but it's really not that bad in reality. The methodology, again, needs to be validated empirically, needs to be based on history at the start, and then over time, as your project system strengthens and as you get more data, you can calibrate it, and validate it, and improve it as you go forward. And also the method needs to address all these different factors like bias and complexity. So that has to be built into this and to make sure you're not missing big elements of the risk pod. Finally, like I said, the tools we have to effectively support the needs of the customer. The customer is either project controls for their need to have budgets for contingency and reserve, but a customer may also be the business analyst supporting the investment decision, doing the net present value. They're looking at revenue, they're looking at OpEx, they're looking at CapEx. And if we're giving them CapEx range or distribution, we need to be able to communicate that effectively. As I mentioned, we're going to talk about different types of risks and different methodologies that work best for quantifying each type of risk. And we're going to march through this chart. So the first type of risk we call systemic. And this is a main takeaway of this presentation, is for you to understand systemic risk, because the research shows the systemic risks are actually the biggest driver of cost and schedule uncertainty and this range of outcome. It's not the events, it's not the things that we usually talk about. The source of uncertainty is really the weaknesses of your project system. And the weaknesses may be in the team development, the immaturity of your system, the competencies of the people that are working on it, but also things like the level of technology and the complexity. And there's a long list of systemic attributes of the projects that we know from research. This is not a speculation. This is more or less settled science. We have over 50 years of research on these risks to show what their impact is. There are actually models you can acquire to both identify and quantify these risks. Several of them are available. If you're a member of AACE, they're for free. They're actually in Excel, and you can acquire them and use them on an actual project. I have a model in my own book, associated with the book, that again is also free. And if you contact me after this presentation by email, I'd be glad to give you a copy of that demonstration model. But anyway, the systemic risks, the way to quantify them is a empirically based parametric model. Parametric model typically is based on regression analysis. As the machine learning and AI world advances, that will probably become much more sophisticated, but this is kind of entry-level AI, if you want to look at it that way. But again, we have plenty of research. You don't need to build your own model. You can start with an industry model and then calibrate it to match your outcomes, if in fact they vary. Generally speaking, we've been using this model approach for about 15 years and have really not found anybody that had to calibrate it. The methodology is self-adjusting and addresses any type of engineering construction project, whether it's a process plant, refinery, wind farm, pipeline, you name it, it works for all of them. So that's the first one, parametric modeling of systemic risk. This next slide then is an example of the demo model, and again, if you contact me, you can get a working copy of this in Excel. I actually have clients, not clients I should say, they're associates that are using the demo model in their actual day-to-day project evaluation because it's better than the methods they've been using to quantify the uncertainty, and they've demonstrated that it's actually more accurate. But again, please contact me if you'd like a copy of this. And it's explained fully in my book. The second type of risk are the risks that we're probably more used to working with as engineers and project people, and these are AACE calls them project-specific risks. Most of these are risk events or condition risks, whatever you want, contingent risks. There's all kinds of terminology. They're all basically the same type of risk. But the best way to quantify this, in my mind, the most practical way, I should say, is the expected value method along with Monte-Carlo simulation. If it's a strategic project, you have enough resources and budget, and you can get some experts. You can use the critical path method, probabilistic approach with Monte-Carlo for those projects. That tends to be a fairly time-consuming and difficult type of evaluation, but for a strategic project that makes sense. But for the day-to-day project, expected value works best. Expected value is a very old model. It's simply using the concept of probability times impact. Now, we're not talking about the risk matrix, which I know is a controversial topic. We're talking about actual risk response-based consideration of the impact with the true estimate associated with that, clearly identified with the risk that's involved. And we're going to only do this for the critical risk. Critical risks tend to be the red risks, and I need to go back to that risk matrix, but these tend to be the risks that matter, the risks that could potentially drive the economics of this project off the chart. So those are the ones we're going to worry about. How you actually rate those and judge those is a different issue, but we're only going to identify the 5 or 10 risks that really matter to the decision maker. And we're going to roll that in with the parametric risk to come up with a single outcome distribution. How do we roll them together? Well, we simply, the outcome of the systemic risk evaluation with the parametric model is a distribution curve, and that becomes risk number 1. probability of occurrence of the systemic risk is 100% because it's simply a fact. It's simply an attribute of your project system. So we use that as risk number 1, and then we use the expected value for the other risk events, risk number 2, 3, 4, 5, and so forth. Put them in a single Monte-Carlo model and come up with an integrated output. A little bit out of sequence here, but a lot of folks ask, well, during execution, once we have the project fully defined, we have the team in place, we're very confident about the system, does that risk go away? Can we just worry about the events? And the answer is no. What we know from research is actually that the system, after the data sanction, tends to deteriorate, meaning the project is best defined and the strongest team and the most confidence at the day it's sanctioned. If you come in 6 months after the project has started, what you'll find is the control base is deteriorating, the schedule is not being properly maintained, change management hasn't been executed the way you want. We don't even know what the quantities are anymore with any accuracy, and so we have to continually reassess the system. If the team is falling apart and we're having a lot of turnover in the key positions, all of those systemic risks come to start creep back up and start to affect the work remaining. Risk number 3, escalation and exchange rate, which is associated with escalation. We need to address that for what it is. It's economically driven price changes. It's not inflation. And the most important thing is the price you're going to pay for services. One thing you need to understand is none of the published indices track the price of services. Now, the services could be engineering service, or it could be construction. Those all a service. They're not things like concrete. They are the bid price you're going to get, and so you have to have a method that can track the trends in price of services, which requires some something you're probably not doing right now. So the book covers escalation in quite a bit of detail. I really don't have time to get into it today, but we need to quantify that and integrate it with the other risk. I do need to bring out that this methodology, now we have the systemic risk, attribute to the system, one distribution, pulls into the Monte-Carlo with the expected value. And then in escalation, the model for escalation includes the contingency outcome distribution, includes the schedule distribution on the cash flow. And so everything out of the escalation model is a universal CapEx distribution of cost and time. And as far as I know, this methodology is the only one that can provide the business decision makers with such a universal profile. So you need to look into that. Fourth, if you're a major company or you have mega projects, you have to consider program level risk. Now, there's a lot of talk about mega projects. In reality, there is no such thing as a mega project. Every mega project is a program, meaning that it's made up of pieces and parts that are related to each other. So, a mega project in, say, a mine may have the mine processing plant, the initial mine development, several infrastructure projects for rail and supply water to the mine, and probably 4, 5, or 6 projects, each of them hundreds of millions potentially, and managed by their own project managers. So for that type of a program, we need to give each project manager their own contingency, but we also need to give the program director or the project director an understanding of the risk of integrating and interaction risks, you want to call them, of these projects. An example would be, a common example is the competition for resources. So when you have a mega project, you may have 3 different parts of the project. Maybe each of them has its own engineering and construction contractor. They're competing for the same construction workers, maybe the same material suppliers. So they actually are creating their own escalation situation, and the price of bids are going to increase because they're competing against themselves. That's an interaction risk that we need to consider. There are no new methods or tools at this level. We're simply going to use the tools we have and ask more questions about these interaction risks and then quantify those distinctly. And then we can provide the program director with their own reserve or contingency, whatever you want to call that, but we can give them the means to manage the risk at their level when the projects start butting heads. And this slide just simply gives you a picture of how you would use the same methods to address or evaluate each one individually, and then come back and use them again at a program level. And if the program risk assessment is a bigger number than the sum of the parts of the projects, that additional level amount at the program level can be funded in its own right. Last up here, number 5, is the portfolio level. And the portfolio is essentially all of the capital projects that the owner company has to manage in a given year. These projects may not have a lot of relationship to each other. There is some, but it's not nearly as related as a program. But one of the key risks that comes in a portfolio is that most companies ration their capital. They only have a fixed capital budget that they promise the stockholders that they won't exceed that capital spending. And so as projects in the portfolio are overcost or fast or slow or hitting schedules, often these projects will be manipulated to meet the finance objectives of the company. Some projects might be sped up, some might be slowed down, some may be canceled. Sometimes you'll accelerate a project and move it into the portfolio because you have extra money. All of those things tend to diminish the discipline applied to the project management. Changing anything in a project is not good. So if you start speeding them up, slowing them down, manipulating the cash flow, that's a risk in its own right. So at a portfolio level, the company's probably going to want to look at their overall uncertainty of the actually hitting those financial targets and what that may mean to the overall project performance. Okay, now we've done all of the essential risks building up through the diagram down to the bottom. And again, if you have any questions about any of these, I'm rattling through a lot of methodologies very quickly. Each one, there's a 300-page book. Each one is covered in detail, but I'd be glad to answer any questions as we go. Now, lastly, with the increased focus on mega projects, for those of you who have the complexity issue in front of you, I do want to say that I believe complexity is measurable fairly objectively. It's not an academic exercise, waving our arms with a lot of terms and so forth. It's something that we kind of know what makes up complexity. We kind of know how to measure it. And I provide in the book a methodology for quantifying it. I call it a tipping point measure because, again, this is not a continuous thing which simply changes the shape of a distribution. This is a kind of like out of the chaos world where we cross the tipping point and we have these blowouts. So you're not going to fund that blowout necessarily, but you're going to use the quantification as a warning and assess it that way. And the complexity may come from the combination, a nasty combination of all of the risks. So again, if each one of them is a bad situation, your system is weak, a lot of risk events or stressors, the external risk of the market are also volatile, and maybe you have these interaction risks or project competing. If all of those are happening, there's a very reasonable high probability, maybe a 1 in 5 chance that your project's going to blow out. And you have to go back and look at these individual risks and see if you can mitigate or somehow manage those risks to get that blowout risk off the table. In my tools, like I said, this is really not so much a method to fund a contingency or reserve, but a method to warn management. I have a red, yellow, green kind of mechanism. You can come up with your own. But the chart you're seeing in front of you shows some of the factors that research tells us drive complexity and contributes to this blowout situation. The sheer size of the project is a measure of complication. The decisiveness of decision-making, we know from research, if you have a mega project and they can't make up their mind when a change happens, or you have different venture partners that can't agree on anything, that's a severe problem. The team development, again, if you don't have the right roles, responsibilities, and the skills of the team, that's a bad point. We do know from research that, for instance, a project that is schedule driven, a mega project, almost never succeeds. So if we have extremely aggressive schedule target or cost target or both, that's going to contribute to the probability of this blowout scenario. And then lastly, there's technical complexity and there's execution complexity. So we can have a physical complexity of the asset, but we can also have complexity of the strategy, the type of contracting management and so forth that we're doing. All of those contribute. And then finally, we have the project-specific risks, which are stressors that kind of, if you have a weak situation, those are going to break the camel's back. Lastly, we need to keep in mind who the users and customers, I already mentioned that. So we have two main customers. One is the decision maker. That's the primary customer. They're going to do their net present value, and we need to support them with this universal distribution. If you give the business 5 different curves for different types of risks, they're not going to have a clue of how to incorporate that into their net present value. If they have a sophisticated probabilistic NPV model, find out what they need, what kind of distribution would work for them. Maybe they just need a range. Maybe they just need a worst case. But whatever it is, we have to give them the best value that we can. Then second, there's the need for budgets for executing the project. Generally speaking, that's going to be funding the contingency, funding management reserves for more discretionary purposes or for program level risk. And they're also going to have to fund an account for escalation. And if it's an international project, it's also going to be exchange rate risk. We may have separate accounts for each. And at that point, we have to put a number on it, not just a distribution, but we have to give them budgets that they can manage, and we need to do that effectively. Now, at the end of the day, one of the big, I think, benefits of using this methodology is that if you manage and quantify the risk this way, with a focus on your systemic risk, you are going to continually improve your project system over time. You're going to strengthen that system, and you're going to identify very explicitly and very objectively, the weaknesses you have, and you're going to get better at that. So this makes the risk quantification part and parcel of your overall capital project management system. They're both achieving not only the project focus goals, but just improving over time your system as a whole, whether it's a phase gate system or whatever you're using. In any case, it needs to be backed by reality. It needs to be backed by historical data. So actually, I'm talking about historical data last, but actually it's first. Most of you involved in risk quantification are probably very much reading about machine learning and AI. You can't do any of that without data. So we need to start now, immediately. If you don't have good, reliable project historical data of your costs and schedule and risks that have occurred, if you don't have the analytics capability to assess that statistically, and then ultimately build that data into your models, then you're way behind the times. You're going to be off the chart when it comes to AI. You need to work on data and do it now. So actually, this would probably be #1 in your risk management things to do. Get the data. Because right now, the state of the industry is we're just making things up. The methodologies we're using with monte-carlo and so forth are mostly purely subjective. Very little historical data other than maybe the weather, which is somewhat irrelevant in the big picture. We need to get better at database management. A lot of companies then ask me, okay, this whole big thing, it looks kind of complicated. Does it work? How can you demonstrate that? So I'm going to simply offer a presentation that was done by a company, a pipeline company. It's the world's largest pipeline company, as far as I know, that has applied all of these methodologies. And the diagram in front of you shows the longitudinal path of their improvement. If you look on the left of this chart, we have the range of cost outcomes on our capital projects at the start. And step by step, this company implemented improvements, not in their project system as a whole, but also their estimating and risk analysis and escalation and all these good things. And you can show they started improving the predictability, but also the cost effectiveness of their projects. So it's an excellent paper. It's referenced on the lower left of the screen. I would recommend you get a copy of that, read it. You can send me a note. Drop a note in the comment box here, and I can forward you a copy of this paper. But we do know that improving these methodologies does improve your outcomes. By the way, this company, I think last year, executed about $20 billion of capital investment. So the scale of their investments is not small. It's in the tens of billions of dollars. Getting near the end here, some last observations. These methods have been used by both owners and contractors. The risk exposure of contractors is a little different than an owner, and their process as a whole is different. They have to make two decisions. They have to decide whether to bid, whether it's worth the risk to them to even invest in preparing a tender or a bid. And then once they do get awarded a contract, they have to quantify their own contingency and reserve. But these methods can be applied with some different variations just as effectively for contractors as owners. I do have contract clients using it. The other thing that most people find kind of interesting is that the method is universal for engineering and construction, meaning it has been applied in just about every project type, whether it's transportation, rail, road, or in a process world, or utility, power, wind, subsea, oil, even nuclear power. The method is self-correcting, the systemic and the parametric method, because it addresses the level of technology, it addresses the level of complexity, and so forth. So it's a self-correcting model. And in the book, in chapter 15, I show tests or validation of the demonstration model against research studies out of these different industries to demonstrate how it is able to realistically address the uncertainty for those different types of projects. Now, no, you're not going to use a model right off the street with a lot of confidence. So all the clients I have that use this model are recommended to collect their own data and use that to calibrate it, determine whether they do have unusual biases or maybe some unusual system characteristic that we haven't captured. But it's a requirement, more or less, that you get historical data to start calibrating the model. Eventually, if you get enough data, you can build your own model. So some takeaways. What I'd like people to walk out of this with is to understand there is no one method for all types of risk. You can't just use monte-carlo against your estimate spreadsheet and expect any kind of realistic output. It does not work. You have to integrate cost and schedule and so forth. So anyway, you're going to have a hybrid of methods. Parametric for systemic risk, expected value for risk events and so forth, and put them together in a practical way. The second takeaway, I want folks to understand the nature and the primacy of systemic risk. Why those are important, how do we measure them, and how is the best way to quantify them. If you're really going to get into this, you need to understand the research. Like I said, there's over 50 years of research on systemic risk, quantitative research, to demonstrate the methods and the range of the outcomes and so forth. This is not, this is more or less, like I said, settled science for that particular aspect. And then finally, you need to understand that when we quantify these risk events in our risk register, by the way, I don't use the risk register directly for quantification. It's not the purpose of it. But anyway, we need to extract from the registers the risks that matter to the decision, and we need to consider the risk response. So when we do our risk workshop, the risk workshop shouldn't be a round table just asking for high and low numbers from a bunch of people on the team. It should be a discussion about what is the risk response if the risk happens, and then we make that the scope of the impact estimate, and we specifically consider cost schedule trading. the decision that needs to be made when the risk occurs, and the business needs to be involved in that decision. Do I want to be fast, slow? What's my objective of the project? We need to consider all that in the risk workshop or associated with it. That's usually not done. So I ripped through an awful lot of material very quickly. I hope some of you posted some comments that we can get back to you on. And I hope this helped your understanding a little bit of what the types of risks, how to quantify them, pull it all together for the improvement of our customers, who is the project controls world and as well as the decision makers. So that's all I had, and I appreciate you listening in.